Folks, happy Sunday. Welcome to a new trading week. The futures are now open, and we will be talking about has the commercial real estate crisis, has it begun to take impact the stock market? And I'll give you reasons as to why we should expect it to impact the stock market fairly soon. But I do believe that we saw a chink in the armor of the stock market last week as the 10-year yield ripped through and, most importantly, closed above 4% for the first time in quite a while. And the last time we traded up to 4.33%, I believe it was, on the 10-year yield, equities went this way. So we're going to flip on the screen here. I'm going to share it. We're going to go over the futures. Then we're going to go over some news that's out there and some conversation with regard to commercial real estate, the impact on the banks, and a REIT, which apparently is now going to turn in the keys to their banks on 19 properties. One REIT, 19 properties, probably they parenthetically or in quotations, likely to default. So let's begin with, this is a 5-minute chart. This is really quiet open. Usually I go with a 15-minute. We have a gap up or gap down. Not much happening here whatsoever. We are flat. We were up slightly. Now we're down slightly. Not much to talk about. I think the thing to take away is that Friday afternoon, we had a serious sell-off across the board into the close in the equity market, and stock traders do not like that. And as I always like to say to members, it doesn't matter where you trade intraday. What matters is how you close. And we had a horrible, horrible close on Friday. And typically Friday is a short covering Friday. Traders like to lighten up on positions going home for the weekend. They don't want to go home short out of fear of headline risk. So E-minis, they are flat. Let's say hello to folks. Franklin, welcome. Tim, hello, sir. Seymour, welcome. TF Hatter, thank you very much. Paul, welcome, sir. Hey, Talon, good to see you. How's the audio? Hopefully my microphone is on. It is on correctly. Good. Okay. Settings look good. Paul, we got a break today. It was really hot over the weekend here, Paul. But I'm sure it's hot now. How hot is it down there? Bob, the SPY on Friday gave a gravestone doji on the candlestick. Yeah, I mentioned earlier that close was not good. The only thing that we need to really put into perspective, and this is particularly the case for the triple Qs, which did not have a good close. Names like Tesla did not have a good close, but the volume was fairly light. I think the S&P 500 volume came in, if memory serves me from the weekend commentary, rolled in at about average. But the Qs, I know Tesla volumes, the reason why I didn't add short, was very light. VIX was down on Friday. That told me that you did not have a lot of institutional sellers out there. So if they're not looking to lean into the short side, I'm not either. So, and I do have a video coming out probably tomorrow morning about my thesis about why equities are going to crash in either 2023 or 2024. Some of the charts I'm going to use tonight. It'll be a little bit redundant, but that should be coming out. I had hoped to have it out before this video, but it should be out in the morning. It took way too long to edit and to render. Tim, thank you, sir. Jeff, yeah, high yield debt. I saw a chart on Twitter. You know what? I'm going to make a note of that to go over high yield debt, because if memory serves me, I believe it was on Thursday, maybe it was Friday, the chart of HYG, which is junk bonds, junk bond market. HYG, you can look at JNK as well, broke support. So from I have not gone over the chart myself. It was somebody else's chart, but it looked as though it was a pretty bearish chart. Tim, heat index in Englewood is that's massively uncomfortable. Hate humidity. 88 degrees. That's not too bad for you guys down there. Okay, so let's get back to the futures action. I think it's cooler than that here, or not as hot. It's a very cloudy day today. Let's take a look at the NASDAQ 100 up fractionally. You can see the sell-off into the close on Friday was not pretty. The Dow Jones Industrial, I mean, there's nothing happening here. Nothing happening at all. We are, it's only a 5-minute chart. Nothing happening here. We're flat. It's a very, very quiet market. Dow Jones. I think I already have this one up here. Down fractionally. Hey, William. Thoughts on Disney? Looks like Indiana Jones movie is set to lose hundreds of millions of dollars for them. You know, as long as these companies, I don't know anything about the Indiana Jones movie. I'm a huge Harrison Ford fan. I love the Indiana Jones series of movies. So I'm not bashing it. I'm not saying anything poorly about it. But Disney, in and of itself, as long as they continue to push a woke ideology, and I know with several of their animated movies, that it's very, very woke stuff. It's in your face. So as long as they continue to push that stuff, they're gonna pay. Go get woke, go broke. I mean, look at Budweiser, look at Target. Target looks like it's gonna break to new lower lows. Budweiser is dead man walking. Nike is dropping like a rock. Their inventories are through the roof. So I don't know of any real companies that are woke and proud of it that are doing really, really well. I'm not saying that about Indiana Jones. Maybe it's just a poorly made movie. I don't know. Or the timing of the movie coming out with the other movie that had to do with child sex trafficking. I don't know the name of it, forgive me. But that apparently resonated with people more so than Indiana Jones. So, especially with the media bashing that movie, that made people want to go see it all the more. You know, nobody likes the media, like zero people like the media. So if they're bashing the movie, that means it's probably pretty good. So getting back to the futures here, we'll go over the chart of Disney out of curiosity. Again, Dow Jones not doing much here at all. I want to check in with volatility. Volatility is rising. I'm shocked. Oh my God. God forbid. Lower left, the lower right, I should say. Let's bring it up on the big chart. Now, this is not the VIX index. This is the front month VIX contract, and they do trade differently. So here's a 15-minute view. This is a good move up higher here at the open. You could see how lethargic volatility was even into the close on Friday with equities taking a nosedive, and now volatility is beginning to pick up. And we're up over 0.75 of a percentage point. So let's see if this holds up. We're still in a trading range, / downtrend. So I'm very skeptical of the VIX until such time as it breaks out and we get a breakdown in stocks on volume. We need volume, and we need that down day on volume validated with an up day on VIX. We're not getting it on a consistent basis. Highly inconsistent. Maybe one day they're doing their inverse correlation. Otherwise, we're not seeing it. So that just tells me that big market participants are not loading up on VIX options to hedge their portfolios. End of statement. Moving on. Let's take a look at the US dollar, which on the week last week had a horrible, horrible showing And in fact, on Friday was a bloodbath. And you could see here that Friday was just absolutely abysmal for the US dollar. Now, we're about flat from where we closed on Friday, but I'll tell you, while we may get a pop here, you take a look at the closing price action on a weekly time frame of the euro and the yen. We'll go with the yen first. The yen has been very weak of late. Let's go to the weekly chart. Very weak. But what we did is we pulled back and we retested support. We were talking about this with members, and in fact, the machines, they are continuing to remain short of the yen. But my guess is that we have some stealth covering here, and in all probability, we're going to see the yen move higher. Why is this important? Watch the commodity complex. If the dollar drops and equities do not correct, well, that is going to allow for commodities priced in US dollars, which is by and large most commodities, to rally. You also need to keep an eye on your gold mining stock, silver mining stocks. Now, the caveat to that bullish statement is that if I'm right and we're beginning to see a correction in the overall stock market as we hit resistance levels on the S&P 500 and on the triple Qs, well, that's kind of redundant. You're going to get a pullback. And if you get a serious pullback in the equity markets, well, then everything's going to pull back as well, along with the gold mining stocks, because margin calls are going to go out and people are going to sell, or their brokers are going to do it for them, forced liquidation of anything that can be sold. So be careful of the declining US dollar and chasing gold stocks up higher. It didn't end well for gold stocks on Friday. They closed up, but they closed off the session highs, which is not bullish. It's kind of bearish to me. So yen, what I think is setting up here is a higher low, and we have broken out on a weekly time frame. This, my friends, is not good for the US dollar, because as weak as the yen has been, that is not the case for the euro. Now, the euro, which I thought I had up here, the euro has been very strong. Here's a weekly chart. It's been very strong. It bottomed out last September, the week of September the 26th. We have been in an uptrend. That uptrend is intact. And it appears as though we are going to move up higher on the euro and on the yen. If that happens, there's pretty much no way that the US dollar is going to rally along with the yen and the euro. It's not going to happen. So if they rally, dollar goes down, gold should bid. Let's check in with gold now. It looks as though the euro is down pre-market. Well, they opened it up, but it is now flat on the session. Let's check in with gold. Gold up slightly. Nice open here, at least in terms of candlestick. That's weird. I'm on a 15-minute chart, and we have two candlesticks already. It's only 6:14. Now it's 6:15. Very strange. All right, so gold up. No great shock. Checking in with other commodities. Let's go to silver. Silver is up spot 1.3% in the pre-market. Platinum, of which we have initiated a long trade. We did so, I think it was the week before last, when it was getting beat up really bad. The shares or platinum spot price is up. We own the PPLT. That's the ETF, puts you long of platinum. And it is looking good. Looks like it wants to go up higher. Good. Let's stick with commodities for a moment, taking a look at nat gas. Nat gas, which got beat up last week, up nearly a percentage point. Nice move up higher, higher low. 15-minute chart breakout. Stokes rising, RSI rising. Good looking chart. Let's check in with oil. Oil, which had a great week last week, and I'm bullish on oil. I think it's going to probably move up, given the fact that oil rallied. There was a publication on Zero Hedge that the Biden administration had for the 14th consecutive week unloaded petroleum onto the market out of the Strategic Petroleum Reserve. What did oil do? It went up. That leads me to believe that oil traders are seeing the light at the end of the tunnel, that we're probably closer to the end of Biden manipulating the oil markets, and that if we get a stabilization in demand, or God forbid, an increase in demand in oil, well, then you can see the price of oil move up higher as well. So the chart looks good. It looks as though it wants to break out higher. We're down right now, but I think that this is just a pullback off of a strong weekly close last week. Home heating oil, that's rallying. I got to fill up my tank. This is going up. Okay. Got to call my wife. Got to get her, have that truck come over here, fill me up. All right, let's stick with commodities for a moment. Let's go to the protein markets. Take a look at live cattle futures. They want to go up higher. My God. I heard that Ireland is planning to kill 200,000 cows for climate change. These people are, I don't know what to call them. I don't know what to call them. Like we have dozens of Bond villains running these countries, including our own. So we have live cattle futures. This is going up higher. Very bullish chart. Pardon the pun. Let's take a look at agriculture prices. They had tumbled somewhat. Let's go to corn first. Yeah, look at last week. Hammered. Oh, actually, that was the week before last. Last week, they were up. We're up slightly at current. Soybean prices. Wow. They rallied them last week, faded on the week. Looks like they want to go lower. Wheat prices. They broke support. Well, actually, they did a retest. They broke down below support here. In yellow. Week before last week, attempted to recapture. There was a rejection. Looks like wheat prices are going to go lower. Let's check in with yields. Yields are up yet again on the week. The high of the week last week was 4.083. Now, we left the day pretty overbought on yields, therefore oversold or extended to the downside on bonds, not extreme oversold levels. So we can get a 1-2 day rally on bonds, alleviating the stress on yields. But I think that any rally in bonds is going to fade. We're going to roll over, and yields are going to press up higher. I just listened to an interview with Kathy Wood, nice person. She's calling for deflation and a pullback in interest rates. I don't think we're going to get that right away. I just don't believe that. I think that any decline in interest rates, and I will credit her with this, she did say she's expecting a hard landing. So I think what she's got is, maybe she didn't articulate it well. I think that what she misstated or did not articulate is that due to the hard landing, the Federal Reserve is going to need to cut interest rates. That's what I believe that she meant, but it didn't come out right. So if that's what she meant, I completely agree with her. We are looking at a bit of disinflation in the markets. It can continue. So the only thing that could derail this inflation is an increase in energy prices in particular and food prices. Now, I know that's not part of the core, but the core is already sticky. So that really hasn't pulled back much. So if you get a resurgence in oil prices, nat gas prices, you're already seeing that happen a little bit. That's going to be a problem for the Federal Reserve. Therefore, a problem for the equity markets. So I want to know here, new weekly higher high. And we'll see how the market digests that new higher high. It's going to be interesting. NASDAQ futures have found their footing. Actually, they're still lower. They sold off, and now they're rallying back a little bit. We may have on the 10-year yield a intraday head and shoulders setup pattern, 15-minute chart, left shoulder, head, right shoulder. We were looking at a weekly chart earlier. Let's go to the big chart. Let's drill down to a 15-minute chart. Not as clean of a head and shoulders picture as the TNX is showing. TNX is just an index, whereas what we're looking at is the July front month contract for yields. So we'll see. Can we take a look at gold and your thoughts on its future direction? Sure. I picked up some 2x leverage UVIX. I got to tell you, TF, and I may have said this before, so forgive me if I have. I don't like these VIX products, these leveraged products. There was one out there called TVIX, and the time decay was so horrible on it. You know, there are days where the VIX would close up and TVIX would close down, and it wasn't just once. It happened a lot. So just be careful. Just be careful with them. Yeah, I know what he's saying, William. You're saying this is regard to the Indiana Jones movie. I haven't seen it, so if somebody could let me know, was there woke stuff injected into the movie? Is that what turned people off? I hadn't heard that. If that's the case, but I'd be interested in knowing, or were they just beaten out by competition? Which is all right. That's going to happen. I mean, this isn't movie number 5, and it is an old. What do you call it? I forget what you call it. Dynasty. All right. VIX coming in here a little bit. NASDAQ down slightly. Let's go to economic data coming out this week. Okay. So the thing that troubles me about this week is that we have on Monday, right out of the gate, we have 3 Fed heads, including the vice chair, out tomorrow giving speeches, which is usually not good. And there's a lot of them out this week. So Monday, you have a potential catalyst, I'll call it. I won't say it's a bearish catalyst or a bullish catalyst, a catalyst one direction or the other to send the markets whatever direction the Fed wants them to go. The 11th, we get the NFIB Optimism Index. I believe that's the small business survey, I believe. On Wednesday, we get CPI. So the number to watch is this one here, core, X food and energy. The news is going to talk about this one, headline. So they're expecting both core and the headline number to come in at spot 3%. But this is really the number you're going to want to watch year over year. Month over month, it's really volatile, right? You want to watch your year over year. That's seasonally adjusted. So, important day on Wednesday. We're also going to get two more Fed heads after the announcement of CPI. Barkin's going to be out. When CPI is released, I'm sure he's going to have comments on that. You're going to have Bostic out at 1 p.m. Later on, an hour after him, you're going to get the Federal Reserve's beige book. So there's going to be no official announcements out of the Federal Reserve this coming week, but there is certainly a overhang or a presence of the Federal Reserve in the markets, and they're going to be talking about them. The news pundits can't help but not talk about the Federal Reserve. So I keep it very, very simple. What are market participants expecting the Federal Reserve to do when it comes down to raising interest rates? We're going to go over that chart in a moment because it's never wrong. But they'll use this. They'll use their pulpits to bully the market one direction or the other. On Thursday, we're going to get PPI. That's producer price index. That's inflation, not at the consumer level, but at the producer level. Another Fed head after that. This is funny. The federal budget. We don't have a federal budget. There's no such thing. So they'll just take that off and save themselves the humiliation. On Friday, consumer sentiment comes out. This is the preliminary number for July. So this is the first glimpse for consumer sentiment for July. XLY showed a little bit. That's the consumer discretionary stocks, a little bit of weakness at the back end of the week. So watch it. It is extended. Consumer sentiment comes in. You can bet your bottom dollar that ETF is going to come in as well. Now, moving on to S&P 500 seasonality. This is TrendSpider, folks. If you want AI, automated technical analysis, incorporated into your charting to help reinforce your skill sets, 35% discount code below. So we have seasonality. I don't want to use 31 years. That's a little bit too much data. Going back 24 years, that'll do her. This is generally an up week for the S&P 500, up 63% of the time. Drilling down to a weekly view, pretty consistent with I believe that this is the coming week, 74%. So a pretty good week for the month of July we're heading into. So seasonality-wise, odds favor bulls. Now, taking a look at the triple Q, triple Qs on a weekly basis, consistent with the S&P 500, and taking a look at the monthly view, up 71% of the time. So both indexes were shaken. S&P 500 and the Qs were shaken last week. Let's see if there's any follow through. We did see some breakdowns. Tesla broke down on Thursday, attempted recapture of a support level on Friday, but an utter rejection by the end of trade, and it closed very, very poorly. Now, on Friday, I want to show you this beautiful, beautiful website here. Ashford Hospitality Trust. Let's visit their leadership. Jay Robinson Hayes, a fine young chap, well dressed, very well groomed. Their CFO, I'm not going to go through all of these. Derek Eubanks, finely dressed, sure he went to a good school. There is only one problem. Their stock is in turmoil. When I look at a chart like this, I think of ongoing concern issues. And I have warned, coming on here live for quite a while now, going back way before the regional bank crisis back in March, which I do not think is done. And I've been warning about this commercial real estate problem, that the way these REITs have these deals structured, they set up LLCs for each individual building. They ring fence that building so that if they default on the building, the banks can't come after their other assets. So this came out on Friday. This company here, Ashford Hospitality Trust, Hotel REIT, says it will likely return 19 properties to its lenders. They're mostly in the hotel business. I'm not sure if there are any office buildings in this, but I wouldn't rule it out. But I think it's just hotels. So Ashford Hospitality Trust expects to return 19 hotels to lenders in its cities, including Las Vegas and Atlanta. And these are not cities where you're seeing the ruination of the cities by the DAs, by the corrupt politicians, like New York City, like San Francisco, LA. You don't see that in Atlanta. You're not seeing that in Las Vegas yet. They're not immune from the commercial real estate crisis. So they're declining to pour more cash into the properties, which were part of a $982 million mortgage pool that missed a repayment deadline in June. So what the banks want them to do when they refinance their mortgages is say, hey, Ashford Realty Trust, you're that loan you have coming up on the 19 properties. Jesus, we're not going to be able to refinance the entire deal anymore because, frankly, the property is worth less than it was the last time we priced out a mortgage for you. You're going to have to pony up some cash and help finance the deal. What do you get? Nah, I don't think so. Here are the keys. It's all yours. Good luck getting the money out of us. So the chipping away at the foundation continues. Keeping the hotels would have required a down payment of buildings they already own, a down payment of about $255 million to extend the financing, and $80 million in capital expenditures through 2025, Dallas-based Ashford Trust said in a statement on Friday. This was released after hours on Friday afternoon, 5:47 p.m. At this time, it appears that most likely outcome will be consensual transfer of these hotels to the respective lenders. Here are the keys. Take the buildings. Adios. We're out of here. That's what they're going to do. So no need to go through all this. I think you get the picture. And the bigger picture is this. And buckle up. Okay? Buckle up. So this is from the St. Louis Federal Reserve. Commercial real estate prices for the United States. They are now negative. There are only 3 times in the past on this chart where commercial real estate prices have gone negative, and only one of those times thus far have we not gone into recession. Technically, we've gone into it 3 times. 2 times we've gone into recession. That was back here in the financial crisis, then back here during COVID. We did briefly go negative back here in 2016. But then you remember, we had Powell come in, and what he started doing, Trump to Powell, jawboning him, cut rates, cut rates, cut rates, cut rates. And he did that. But here we are yet again. And now we are firmly down below the negative territory. Here's the zero line. We are negative year over year on commercial real estate prices. And what is the Federal Reserve planning on doing? this month, they plan on increasing interest rates. Again, what was the proximate cause for the commercial real estate crisis? In March, the Federal Reserve raising interest rates too quickly, and yes, poor management, risk management by the banks that went under. One of those banks did not have a CFO for 6 months. Think about it. So it's a foregone conclusion. This is the chart I referenced earlier that, and this is the highest that I've seen it, I believe. Yeah. We've been at 93 for the past couple of days now. 93% of market participants are expecting an interest rate hike. And what are yields doing? Here is the weekly chart of the 10-year yield breaking out. This is a problem, a major, major problem for the equity markets. Look at this breakout. So I misspoke earlier. The peak yield I said was 4.33. It was actually 4.25 on the 10-year, and that is when equities began to buckle, including the big triple Q names. And we are now trading at least as of the close on Friday, 4.06%. So a major move last week, a quarter, a 25 basis point move. In fact, if we have an equivalent move this week as compared to last week on the 10-year yield, we will close out or potentially close out above the highs going back to October of 2022. Buckle up. The indicators, RSI, weekly time frame, very strong. Stochastics, very, very strong. We closed at the highs of the week. And if you want to take a look at bond prices, TLT, this is the 20-year, not the 10-year. We broke support last week. I think what they're going to do is they're going to bid TLT up, dropping yields for a day or two. But then I think that yields recover and will close out the week fairly strong. That will not be bullish for equities. Another issue that's out there, I went over this chart a few weeks ago, and this is a monthly chart of bulls versus bears, and it's a sentiment indicator. And where we are trading at current is just shy of resistance, where we saw these spikes up get rejected and a correction ensued in the equity markets. This was a measurable one. This one really not so measurable. This one here, going back to December of 2021, was very, very measurable. And it lasted for quite a while, that correction. So beware. We're back in that neighborhood of where that overly bullish sentiment in the markets is a danger to the markets. And the VIX is apathetic as well. You're getting down days in equities, yet VIX is down as well. So there's a lot of apathy in these markets, and that sets the stage for a lot of problems for bulls. Another issue that is kind of being ignored. What you're looking at here are job openings. And you can see that job openings in blue are declining. Yet the Wilshire 5000, it's an index of stocks, and that is continuing to trend higher. That is not supposed to happen. Historically, not supposed to happen. If you go back in time and you see job openings go into a decline immediately or shortly thereafter, you see the Wilshire 5000 move lower in conjunction with job openings. Same thing happened back here during the financial crisis. These are fairly correlated, 2020, same deal here. Yet there is a divergence, if you will, a divergence between job openings and the Wilshire 5,000. At some point in time, this is going to have to get recorrelated. And you can see as recently as 2022, job openings rolled over, equities rolled over as well. Equities have rallied back, but they're not acknowledging the rollover in non-farm payrolls. That trend is clear and defined, and it's moving lower. Yield curve. So for those that are out there that are new, yield curve has predicted every single recession since 1955. We are inverted. This is 2s versus 10s. And I always say this, don't panic when it's inverted. Worry about the steepening. Worry about the steepening. What happened last week? We steepened. What happened to equities? And if you go back to March of this year, right back here, you saw a follow through on here. Here's March here. We broke out on the yield curve, moved up higher. What did equities do? They toppled because the banks are in big trouble. Now we are seeing a re-steepening. I think this all has to do with headline news like this, along with commercial real estate prices across the board declining, and a Federal Reserve which continues to threaten to increase interest rates even higher. And we're kind of getting to the point where we're mixing oil and water. They don't mix. Lastly, another threat that's arising out there is China. We recently cut off the sale of high-tech semiconductors to China, NVIDIA chips. That's why NVIDIA had a brief correction a few weeks ago. And the Chinese, it appears as though they are now retaliating, and they need to. They're a basket case over there in terms of their economy, their stock market. This is the FXI, China basket of stocks, and they are clearly in a bear market, threatening a potential breakout here, but no breakout as of yet. So therefore, we remain in a downtrend. Now, whenever a country is in dire straits internally, what do? They strike out externally, so they get a foreign adversary to go to war with, to keep the people's minds off of the corrupt powers that be in their own country. You see it here in the United States. China fires warning shot. This is as of today. China fires first warning shot with metal export controls as traders scramble for gallium. I got to be honest with you, never heard of it. It's not on my futures list, so therefore it doesn't exist. Beijing is furious with the Biden administration mulling over broader semiconductor chip export bans in a response decided last week to announce export restrictions on two metals, gallium and germanium, which are heavily imported by Western countries for semiconductor components. It gets better. Battle for tech rare earth minerals. China is the pimp Mac daddy of rare earth minerals in terms of production. We have them here. We just don't mine them. I believe Australia has them as well. So rare earth minerals, very, very critical for semiconductor production. And in fact, I just remembered that there is an ETF. I guess it's not around anymore. Oh, here it is. Here we go. REMX. This is it. Oh, this is an interesting chart. So this is one that we want to keep an eye on. As this rhetoric begins to heat up, the correction in rare earth minerals appears to be nearing an end, and we are threatening a breakout on rare earth, REMX, rare earth minerals, ETF. So we'll be watching that one. Let's do some chart requests. Let's get rid of this. Folks, we're going to be using TrendSpider again, 35% discount code. If you have any questions about it, leave a comment and I will answer it. If I can't get an answer for you or I don't know it, I can get an answer for you because I know their senior leadership team. HYG. Yeah, this is broken. This is broken. I haven't been watching this for a while. The last I looked, it had been holding up. It's broken, but we broke out. We recaptured a upper band of the downtrend channel last month. Now we're doing a retest of that breakout point. So I came into this analysis expecting to be very, very bearish. And technically I am. I'm not overly bullish at all, but I'm seeing opportunity here. Let's do a deeper dive. Let's see how we closed out the week last week. All right. So yeah, it gets a little bit worse here. This is not good. So here are your fractal trend lines, upper band of resistance, lower band of support. We broke out back here in June, did a retest, got a follow through candlestick. This is what I always look for. Breakout, always look for the retest. You could nibble here, add more here, finish your buying here on the continuation move up higher. This time around, it wouldn't have worked out for you because last week we failed to hold support. Looks like we're going to retest monthly support this week, unless we gap up, entirely possible. And we were down on volume, not horrible. Stochastics I'm not liking. RSI I'm not liking. Momentum is clearly not favorable. Daily view. Big gap down on big gap down on Thursday of last week. My guess is that this has to do with the spike up higher on interest rates, because that means that the debt, think about the whatever you think about higher yields on treasuries, they're perceived to be risk-free. I find that crazy, but they're perceived to be risk-free, and they're a benchmark that every other bond issuer has to compete against. So if you take a look at the HYG, it has to, the companies have to pay higher yields on their debt, on their junk bonds, because the cost of money, if they don't pay up more on those bonds, people will just go to safety in treasuries and get paid a reasonable rate. So interest rates need to go up on high yield debt if yields are going up on U.S. treasuries. Now let's take a look at XLU. Why XLU? This is only a guess here because I haven't looked at this one in a while. It managed to close up last week, but this is under a tremendous amount of pressure. Why do you want to avoid utilities in this environment? Because utilities are capital intensive. They must issue bonds to expand operations, for maintenance. They're always issuing bonds. So while they are fairly reliable, they're certainly not as risk free as treasuries. So if the treasury bond yield continues up higher, what must the XLU or utilities do? They need to pay a higher yield on their debt. What happens to their earnings if they don't increase prices? Well, that impacts their earnings. So the EPS gets squeezed. And you're not going to cut much cost out of these things. So beware high yield debt and the utilities in this rising interest rate environment. Disney. Let's go to the monthly view because this looks horrible. This is not looking good. So Disney broke historical support back here in May. For the past 2 months, it's been attempting to recapture that support level, each time rejected. Volume on the month so far appears about average, maybe a little bit lighter. Weekly view. Now here's the value of the automated trend lines. You have support down here at around $87 per share. If it breaks that support level and closes there on the week, Disney's going a lot lower, probably down to this lower band of its downtrend channel at around $77.50 per share. Now, the stochastics are oversold, but they could stay oversold. So you really don't want to be buying the shares of Disney right now, simply because you have Stokes that are down below 20. They can stay that way. They can go to extremes like you saw back here in April. Daily view. The daily chart, they're trying to break it out. It's just being rejected. So I'm a no buyer on this one until such time as it closes above $90 a share. It's got to close above $90 a share. So right now, I'm in the bear camp on Disney. Gold. I don't know what the spot symbol is here. Let's bring it up on stock charts. Now, this is a monthly chart of gold. We are at very, very critical support levels on gold. The problem for gold is this, is that gold does not like disinflation or deflation. What it relies upon to go up is a hapless Federal Reserve not responding quickly enough to increasing inflation. Now, if Jay Powell comes out and disappoints the market, right now they're expecting 93% of market participants are expecting a rate hike. Now, if they don't get that, let's say he stays on pause and inflation continues on its trajectory at the core anyway, higher. So what that means for gold is that it's going to take off. It's going to take off. But if Powell increases interest rates, that'll keep a lid on gold for a brief while. That does not mean that it cannot rally with rising interest rates. It did so back in, let me see if I have this chart, back in the 1970s. Yeah. So here is the correlation of gold versus the 10-year yield back in the 1970s. In fact, I also have the S&P 500 up here in black overlaid. So you can see that S&P 500 was pretty much dead money throughout the 70s and into the early 80s. Gold was on a tear, but there was a tight correlation for quite a while. This is the neutral line here, the zero level. As long as you're above that zero level, you're correlated with interest rates. So that meant that there was more often than not always, but more often than not, interest rates rising along with the price of gold. What was the difference back then? Here was the difference. Let's get rid of the S&P 500 and let's bring up the US dollar, and we'll make it green. Why can't I see it? Price performance. DXY behind price. Let's get rid of all this. Oh, I know what it is. This is the wrong symbol for stockcharts.com. My apologies. There we go. Okay, so during this time frame, you saw the dollar peak out in 1977, went into free fall. Gold rallied. Yields were very strong at the same time. So we can validate, we could say that yields and gold can rally together. You just can't have the US dollar rallying along with it. Now, the problem in the short term is this, is that for the gold mining stocks in particular, not so much for the metal, but for the gold stocks, because they are a equity. If in fact the 10-year yield continues up, and especially the yield curve, if they continue up, here, and we break out to new multi-year highs on the 10-year yield, equities are going to have a major problem of continuing this rally. And if they go into a correction, you're going to have margin calls go out. You're going to have forced liquidation. The brokers don't care what they have to sell. They will sell anything. What's going to get hurt? The gold stocks. So what'll happen is this. Our game plan here is we're expecting more disinflation, meaning a slowing of inflation. I think that the markets are overvalued, dramatically overvalued. I think that they are not pricing in the risk of commercial real estate, the regional banks, and the impact that it can have on this economy. I think that when this market does go down, it's going to go down really hard. And nothing is going to be spared. But out of the ashes rises a phoenix. And the phoenix that I expect to rise out of these ashes is a rally in gold, gold stocks, silver stocks, palladium, platinum, and emerging markets. Because I expect that the dollar is going to be in free fall. Why? It's because the Federal Reserve is going to have to come out and cut interest rates to stop the bleeding. That will allow gold to rally. It'll drop the dollar like a rock. Equities will rally, but I prefer to be in emerging markets because they're less expensive, and the decline in the US dollar is a tax cut for them. They love a declining US dollar because their debt is denominated in US dollars. So they're commodity producers by and large, or manufacturers. So they make stuff. They export it. They get paid in dollars, and they pay out their debt in dollars. They're doing good. I was in the city a few weeks ago. It looked as most of the town is vacant. 26% vacancy rate in Manhattan. 26%. Hi, Jody. And that's not even worse. That's not even worse out of the country. I think San Francisco is not the worst. I forget which town was. There was a chart I had earlier. If I remember to bring it up, I think it was on Twitter. I'll do it on Thursday night's Futures Live. Hi, Jody. Larry, Treasury look low risk right now and offers slightly higher yields than dividend. Yes. Let's go with short-term Treasuries ETF. Agreed. Paul, CF if you have the time. Sure. We'll squeeze one in. CVS, TMO, and CF. Okay, we'll lock it up with that. TZ Burton, welcome. Sounds good, brother. Thanks for being here. Rivian for Jody. Okay, let's do it. Okay, Rivian. I like this chart. Great week last week, but got to pull back. I have my alert set up here. Looking for support at around $20.05. I think the stock is moving up higher. Absent an event, let's go to a weekly chart. Not enough data there. Weekly chart. I think you're extended very, very short term. You need to see a pullback here. We're leaning into the third standard deviation Bollinger Band on a weekly and daily time frame. I can't initiate a trade there. Where I long of the stock right now, I would probably, as a swing trade, scale out a little bit and put a trailing stop loss on the rest. Uh, would I be shocked if they just spike this up tomorrow? No, I wouldn't be. It's just the way it goes with some of these stocks. So it's a little bit too much of a high flyer for me at these levels. However, I love the premiums that they're being paid here. They report earnings on August the 8th. When I spoke about this on Thursday Night Stock Charts Live, the implied volatility on Rivian was in the 50s. Now it's 88. Very, very attractive. Just beware. August the 8th is earnings announcement. So if you're going to put on a trade, make sure it expires prior to earnings and go very, very wide. So that way you don't have to roll that position into earnings. That's a bad, bad play. You are welcome, Jody. Okay. CF Industries, higher or low weekly chart, looking good. It recaptured support back here, the week of June the 12th, retest 1, retest 2, continuation breakout. Weekly chart looks like a buy. Volume could have been better. I'm liking rising RSI, rising Stokes, all that good stuff. Basically, momentum is building. One caveat here, here's the value, automated technical analysis. Sorry, it's insanely helpful. We have here resistance in green. So we're at the upper band of its trading range. We also have a volume shelf right here. So there's pretty stiff resistance. I would be a buyer. On a breakout above the upper band of the downtrend channel. No sensitivity. All I care about is a close above that mark. A little bit of note to self. And we're good to go. Set it and forget it. If it doesn't fire off, we don't make the trade. If it fires off, then we'll revisit it and make a determination at that time. It all depends upon how the market feels. And RSI, stochastics daily time frame, looking very, very bullish. CVS. Not much has changed since the last time I went over this chart. It's broken out. It's done a couple of retests. I think that this is looking interesting. Let's take a look at the daily chart. I think that this could be bought. I don't like Friday's candlestick. That implies that we're probably going to move lower, but we may do a retest of that $69 per share mark. If we get down there, I would have no problem with opening up a position. We're not that far away. I mean, where do we close? 69.17. I mean, we're only a couple of dimes away. So I would just see how the Monday morning session plays out. Do they drop it? Do they reverse it to close higher on the day? That would be my go signal to buy CVS and get long, and then buy on continuation breakouts higher, as I have noted here. So I would nibble on a reversal day to the upside on Monday, Tuesday, whenever it happens, as long as we hold support, and buy more on a breakout above, let's call it $70 a share. So CVS looking good, early stages of a recovery. TMO, Thermo Fisher. I haven't looked at this one in a long time. Monthly chart. We remain in a downtrend. We're in a very, not a very, but we're in a tightening wedge formation on a monthly time frame. This can go on for a few more months. So I don't see a compelling reason to get overly bullish here. If you want to scratch the itch, buy a few shares, get it off your chest. I have no problem with it. Selling premium here, if it's optionable, I'm not sure if it is or not, probably is. It's a $500 stock. Then I would look to sell premium, reduce your basis cost. Nice little W formation forming on a weekly chart. I think they may break this out. So I would definitely be looking at premium, maybe selling puts in conjunction with buying a few shares. IV percentile is not great, but if you're selling premium with the hope of having these shares assigned to you, it's not a bad thing. So case in point, I would just worry about when is earnings. I would not do this trade into earnings. So if you're doing, say, 513 per share, you sell a 510 put, you can get generated $6.60 premium. I mean, one contract, you could generate, obviously they're going the midpoint, it's $6.30, $6.40. That's $600. So that's certainly a way that I would look to trade this stock. So it could sit in this trading range on a monthly time frame for a few months. You could still be selling the same puts, generating cash flow with all you need to worry about is having the shares assigned to you at a reduced basis cost. So not a bad situation to be in. Daily chart. A little bit of a reversal day on Friday. So just be careful there. Let's see how Monday plays out. Could be a down morning. Maybe it's going to be a bullish reversal day. It closes back up. We don't want to make judgments quite yet about how it's going to close tomorrow. The market's going to tell us how it's going to close tomorrow. Then we make our determination at that 3 p.m. hour. What do we want to do? That's it, folks. Folks, if I didn't get to you, I apologize, but we're over. And thanks for being here. I have a new video coming out tomorrow morning. I believe I'm going to have it come out. And check it out, please. Like, subscribe, and I'll talk to you soon. Be well. And have a profitable trade.